90 minutes to present. Immediately following the presentation, judges will have a total of 5 minutes to ask questions. The volunteer timekeeper will show time cards at various intervals to indicate the remaining time and will stop any speaker who exceeds the time limit. No questions, comments, cell phones, or picture taking will be permitted from the audience at any time. The audience will only be permitted to applaud following the question and answer period. The audience is banned from any material that bears the name or symbol of a competing university, and we ask that the audience please exit the room immediately following the question and answer period. Competitors, you may begin when you're ready.
Hi, thanks for your time.
Colette.
Thanks for your time.
Nice
to meet you.
Colette, nice to see you. Colette, nice to meet you.
Levi, nice to meet you. Levi, nice to meet you. Levi, nice to meet you. Levi.
When analyzing an organization from an investment perspective, it's essential to not only understand the business itself, such as the financial characteristics, the competitive advantage, as well as the future growth strategy, but as well as understanding the overall industry that the company operates in to truly understand whether that future growth strategy will actually be attainable within that industry. One thing we'd like to point out initially with GoPro is that it was an innovative item and it completely changed the overall camera environment. But with that being said, with innovation comes imitation, and you'll initially see other companies move into that industry. And one thing that we want to point out is, say for example, Apple, with the device of the iPod, that product was game-changing, but it wasn't sustainable. What truly built the business and made it sustainable was iTunes. The software around iTunes was what grew the company, and that's what we want to build for your organization moving forward. And believe that with an update with software and building that overall market, you'll be able to attain future growth that was only attainable within a world of opportunities. Good afternoon, my name is Brock, and with me today are my colleagues Levi and April. And we are here today to present a strategic recommendation based on both qualitative metrics as well as quantitative metrics, and an implementation plan that joins both of those metrics together that will truly produce a sustainable growth rate for your organization moving forward. Looking into our executive summary, the first project we wanted to point out was how to value GoPro itself. We have been provided numerous sources, I guess, and with that we provided a peer set as well as DCF valuations as other metrics that we could use to value the company. And as well with the secondary issues is how do we project future revenue moving forward as we see analysts moving away from understanding not our growth strategy, but just understanding the product itself. And that's not how we want to move forward from a long-term investment perspective. So our overall recommendation is to use a combined discounted cash flow valuation as well as the peer group to truly take into consideration the company's perspectives as well as the industry perspectives and how we want to produce or have our company move forward within that industry. This method essentially will take into our growth strategy of once again implementing that software which makes our product sustainable, and that is something that is essential from a long-term investment perspective. And our outcome will be a more accurate valuation based on all the upside that, like I alluded to earlier, with that software, there's other revenue streams that are necessary for your company to be successful, as well as understanding the industry as a whole and understanding how we arbitrage that area in order to move forward. Here's our agenda. It is provided in the book that's provided to you guys. Please reference it at any point throughout the presentation. So first we want to understand the industry that GoPro operates in. And one thing we want to initially say is that there's a short product life cycle. And what we mean by that is, like we said earlier, there's imitation with innovation. And with that, we'll see other products moving into that industry. And that's why it's essential to use this product that we initially have built and build a company around it with software and other revenue streams that we can use effectively to build our business moving forward. Another aspect is there's low barriers to entry because all we simply have is a computer or a camera device that is used in all situations. But with that, our software device and that attainability and development within that program will make us more effective moving forward, I guess. And because of that, what I mean is, like I said, MP3s, all those things moved into Apple's distinct market and really drove down the overall market share. But the effectiveness of Apple to maintain that overall dominance within the industry is the software that drives and connects both of those areas. And that's what we really want to drive home, and that's essential for your organization moving forward. As well as it's cyclical. And this is something that is very important from a long-term investment perspective because we take into consideration all of those aspects moving forward and how we can effectively have an effective return for our investors moving forward. And because of the cyclical industry, we're able to sustain those overall fluctuations within the market overall. And it does provide a higher return due to the risk within the industry, which is something that's necessary within an investment portfolio, especially a long-term one. And so the bottom line is that GoPro's growth strategy will need to increase its consumer base in order to decrease the volatility within the cyclical industry. And what I mean by that is by increasing our consumer base by having different distribution networks, as well as advertising with other revenue streams, we'll be able to truly attain the actual value within the product that we've really built. Looking into GoPro, the first thing we want to bring out, it was a first-to-market product. Like I said, it's innovative, it's effective. But with that, there's imitation, and that's why it's necessary for your organization to diversify revenue streams in order to attain those long-term investors that you're looking to attain. You have no long-term debt. That provides substantial financial flexibility for you guys moving forward. And we believe that there's any other growth opportunities you guys see foreseeable in the future, you can obtain a little more debt moving forward. As well as strong brand recognition. GoPro is worldwide. And this has really built the extensive global recognition, as well as distribution networks through almost 30,000 stores. And that's something that investors look for to recent volatility, because we're in a globalized market where there's revenue streams throughout the whole entire world. And so the bottom line is that GoPro must diversify its revenue streams in order to reach its future growth projections. And with our implementation and overall strategy, we will be able to attain that. And so we understand that your organization is going into an investment pitch with long-term investors within next week. And one thing we want to point out is that from a long-term perspective, you have to take a top-down approach and understand the overall broad market and the macro indicators, as well as the company-specific and industry-specific aspects. And so what we really want to drive home and make it applicable for you, organization, moving forward into that meeting is to understand how to really make your organization attractive. And so the macro environment that we've noticed over 2014 is that there's strong U.S. employment, dropping around 5.6%. That's really a positive sign for a consumer cyclical product because people will be more employed and have more money within their pocket. The low unemployment rate and the increased consumer confidence, that's because of jobs, and that means more spending. Your product will be bought more, your services will be bought more, and that's what will make you attractive moving forward. That's something you really need to drive home with your long-term investors, and that's what makes it more attainable moving forward. Looking into the industry, it's dominated by one competitor, and that is yourself. GoPro itself overall is able to attain the substantial market share within that industry, or within the industry, and because of that, it has extensive brand recognition. And we believe moving forward, it's an attractive investment from a long-term perspective. Nike or Walmart or any of those aspects are attractive from a long-term perspective because of the brand recognition and the overall dominance within the industry. And that's what GoPro has. Looking into GoPro itself, the strong brand recognition, and it's currently undervalued. My colleague Levi will go into our financial valuation of how we project the next 5 years and the true value of the company and how that will attain moving forward. As well as the expansion opportunities, like we said, into distribution into other networks, as well as advertising within your YouTube channels and your brand recognition through that, as well as the software moving forward. That is the key thing we want to drive home. And so based on long-term fundamentals, GoPro growth strategy aligns easily with a long-term investment risk profile, and we believe that is your overall pitch. You want to go to your investors next week and make this clear to them that this is what the best recommendation would be. And so with that being said, I'm going to pass it on to my colleague April to really go to our decision criteria and how we've outlined all of this and came up with our ultimate recommendation.
Okay, so one of the things that you had asked us to assess was how to project your future revenue growth. So what I'm going to outline here, I'm going to go over the few alternatives and then end up at the recommendation as to the best way for your company to project future revenue growth in this tech industry where it is often difficult for companies to analyze their growth. So we're going to do this by looking at 3 specific decision criteria. So the first is, does the alternative recognize potential upside? So are you taking future growth into consideration with this alternative? Secondly, does it recognize the state of the industry? So are you looking at your competitors and what your company's up against in the future? And third is, does it use more than one financial model? Are you just sticking to one, or are you diversifying your options moving forward? So our first alternative here, we have the valuation based just on the DCF, not including your future potential revenue streams that we'll get into further on your implementation plan. So this one we didn't like because it didn't include your potential upside. So this great implementation, you talked to us about the new revenue streams that you have proposed, and this type of valuation doesn't include that. It does recognize the state of the industry, so we do like that, but then again, it's only using one financial modeling aspect. So those are two primary reasons why we don't like this and have a stronger recommendation for you coming up. Now, our second one is the valuation with the revenue streams incorporated. So this one's a bit better than the previous one as it takes into consideration your future revenue growths. However, it doesn't take into consideration any of your peer companies that we have analyzed further. It also is, again, only one financial modeling system, which we could do better, and we'll show you that further on here. So third is looking solely at the peer group. So this is an important part to look at. It recognizes your peer companies and who you're dealing with and who you're competing against as well. And it looks at diversified financial modeling in the sense that you're looking at your peer companies. However, it doesn't take into account the niche market you have entered and that potential upside specific to your company. So that's why we specifically don't like this alternative. So moving on to our recommendation, this is going to take into account two of the valuations we have done. So this is the peer group. We took the relative valuation we did among that, as well as alternative number 2, which looked at the DCF, including the revenue growth with your new growth plan that we've discussed your future alternatives in that sense. So now, this looks at your industry growth, your specific company growth, and then with the peer evaluation, it takes into all those macroeconomic factors that come into play with all tech companies. So now Levi is going to discuss the valuation and how we came to this conclusion.
Thank you, April. Now I'm going to walk you through the cornerstone of our presentation, which is the valuation. We've spent countless hours reviewing every number and solidifying every assumption to ensure you what I'm going to show you in the next few slides, the most accurate possible valuation based on all available information. Now, what your company wants to do right now is review what the valuation for GoPro should be. So this graph is a summary using two models of a relative valuation and a discounted cash flow. Now you can see the relative valuation using the peer group. Now this is outlined with multiple peer groups, and you can see the different tiers within that graph. And that is because your company wasn't sure what to use as a peer group. So this includes a low, a median, and a high range based on how possible comparables are trading. And I'll speak a little bit more of that later. And the bottom one is the discounted cash flow. Now this ranges based on revenue growth. Now the lower valuation of that is with a lower revenue growth, and the upper is with the highest revenue growth. Now, what we looked at here is a combined, the bottom part, the second line on the left, the bottom valuation, is a 50% relative valuation and 50% weighted discounted cash flow with your historical growth rate, which is 20%. So therefore, that gives us the bottom range of what the stock should be trading at. And the upper range is a 100% weighted discounted cash flow. Now, this is potentially where the company could be trading, which is $144, because the relative valuation is not that accurate, because your company is experiencing higher growth in the industry and therefore higher multiples. So therefore, the valuation will range between $87 with the upper range of $144, which is the potential for the company. So now looking into the assumptions, we had to calculate a discount rate. So based on the fact that the capital structure is 100% equity, we used the cost of equity to discount our cash flows. So with that is a beta of 0.66, which is the publicly traded beta, a risk premium of 7.1%, which is the historical risk premium for the S&P 500, and the risk-free rate is 2.45%, which is currently what the current 30-year U.S. Treasury bonds are trading at right now. So looking into the discounted cash flow, this graph shows how sensitive your company is to revenue growth. So the three lines are a 30% growth rate, a 20% growth rate, and a 10% growth rate for revenue. It shows that that line in the middle is the discount rate that we used, which we do believe to be the most accurate most accurate discount rate based on the assumptions that we came up with. So that line in the middle is where your company would be trading at with different revenue growth, and that 20% is what we use. So you can see the potential upside and how sensitive it is to the growth rates. And we believe that by monetizing the new revenue stream in the coming years, that 30% growth rate is the potential, and therefore the company could be trading significantly higher, and that is not priced into the market right now. And lastly, we had to address the peer group. This is the peer group that we came up with based on current company operations, where they are diversifying themselves in the future, and the current multiples and size. These are the companies that we like because of how GoPro wants to diversify into new revenue streams. So this peer group considers the new revenue stream, the current revenue stream, and these companies trade at similar multiples as well as ours have similar market caps. So here is the relative valuation. You can see how we came up with it, with a low, pessimistic, mean, optimistic, and high range. And this is how the relative valuation on the first graph was developed. And now I'll pass it off to April, who will walk you through the implementation plan.
Okay, so first off, we have two phases basically for your implementation plan. So the first one will happen immediately in the next 0 to 6 months. So this is increasing your presence in new markets. And we want you to do this through distribution channels. So this might include showing YouTube videos at sporting events or different kinds of events that your marketing team will come up with. As well, this could be looking at Faro Technologies. This is one of the companies that you had suggested to us as an option for using it as a distribution channel. We like them because they were more software oriented, and that's where we see your company realizing the most value in the future is through expanding on your software and increasing your presence in this area. So this also includes clarifying your future growth plans to the media. So one thing that investors are a bit unsure of is the revenue growth that you have projected moving forward. So this is something we just want to clarify now that we've come out with an implementation plan and our recommendation for you. Just tell them where you're at, your plans for the future, and just make sure that they are on the same page as you and they see the potential that you have. So 6 to 18 months, this is where phase 2 comes in, and this is where we want you to diversify your revenue streams and capitalize on that extra revenue you could be earning right now. So this includes, you have a channel on YouTube right now, so why not add advertisements to that? That's an easy source of revenue for you, as well as studio software. So right now you're offering free software to all of your users. We'd like you to continue with this free software so your more amateur users can continue to enjoy this free service you offer. But then for the more experienced users with GoPro, you can add in a portion of some of this software and then have them pay a monthly fee on it and capitalize on revenues in that way. So long term, we want you to continue with your product innovation. That's what the tech industry is all about. You have a great product and you just need to continue to innovate it and adapt to what the tech industry asks for, what your consumers are calling for. And secondly, we want you to look into future acquisitions. So this might be acquiring a software company, or we like the vertical integration with the software companies so you can get the different components along the supply chain to increase productivity and profitability as well. And then, like Brock had mentioned, you have the ability to take on debt in the future, as you currently have no debt on your balance sheet, just to keep that an open mind to that. And now Levi will discuss our risks and mitigations moving forward.
Thank you, April. As we have outlined these risks, that would be the mitigation for them. We've outlined the mitigations for them. The mitigation is going to show how these risks can go from being part of the problem to actually becoming part of the solution. So the first one is you're unable to protect current hardware sales. And this is where you can increase brand recognition through multiple distribution channels, such as going on to Xbox Live and providing a channel that way, or using more YouTube channels. And then the second one is you're unable to monetize the software media revenue as it's not monetized right now. But this is where you're going to bring in, hire a team to develop a pricing strategy in order to ensure that that is done and that the right value comes from that revenue stream and it is able to come through. The third one is that your high growth phase ends earlier than expected. As we mentioned, that we use a 5-year high growth phase. This is where the revenue streams will be diversified to ensure that in year 2 and 3 that second revenue, or the additional revenue stream is monetized to ensure that the high growth stage maintains. So now, it has been said that the market is full of people who know the price of everything, but the value of nothing. Today, we have conquered that problem. We have provided you with a valuation range for GoPro that considers both the current opportunities within the industry and the current opportunities within the company. And on behalf of 535 Global Solutions, I would like to thank you for this opportunity and open the floor to any questions you may have.
Thank you all. This concludes the presentation, and the question and answer period will now begin.
You mentioned acquisitions. I mean, how aggressive do you think we could be in terms of, how much we would spend either in absolute dollars or sort of relative to how big we are?
Your capital structure right now is entirely equity, as there is no long-term debt, and the market cap is somewhere around 10 or 11 billion. So therefore, we know that tech companies don't take on much debt, but the possibility is there to add 1 billion, maybe 2 billion, to maintain this growth strategy, to add a little debt to the balance sheet.
So we could spend $1 billion or $2 billion acquiring someone else, is that?
The potential is there, based on the state of the balance sheet right now.
And so for the DCF, what sort of long-term growth rate would you use?
The median range is a 20% growth rate, which is the historical growth rate that we were provided with, but then we sensitized it up to 30%, which could include the additional revenue streams if it is able to be monetized.
The valuation range that you presented, 87 to 144, what if we just concentrated on just hardware and not anything to media? What would
Part of the hardware, if you just focus on that, we want you to continue and move into the software, because like we had alluded to at the beginning of the presentation, that's where you're going to see your growth potential, and that's where you're going to see the company develop and maintain that market share that you currently possess, and hold on to that as well.
Without it, we believe that is a base case with the 20% historical growth rate, and therefore that's justifying that the mid of that range that I provided you.
Have you considered, I guess, currently one of the reasons I'm able to monetize the software media side of things, from current users to now having that change in that kind of strategy? Have you considered what the impact might be?
As in with the adding premium to certain products, we believe that is attainable because there is certain demographics within the target market that we're within that will pay that excess premium because they avidly use GoPro, or they have GoPro channels on any other distribution networks such as YouTube or any other way to do it. And so with that, they'll be able to monetize that and find a return on their own investment. But with the overall lower end, we believe that won't be impacted.
So we go ahead with this strategy, and we're creating in the 80s right now. When would we expect to see something up at 140?
That will kind of happen once we get more of our demographics. Initially, how we want to work it is we want to increase our distribution networks, which will increase our consumer base, which will make us more sustainable in the long term. Our revenue streams will come from the increased YouTube ad revenue and other revenues like that for the short term. And then the software update will, once again, make it more sustainable. We're looking for more of a sustainable investment. So we see that maybe in the next 1 or 2 years, as long as we increase our consumer base to make it more sustainable and reduce our overall impact on the market.
So what do you think we should be telling the institutional investors
We should really make it,
next week?
next week we should really make it clear on our whole growth strategy, as well as understanding how our long-term expectations meet their long-term investment projections and risk profile.
And just, do you have any concerns about the future of our hardware business? I mean, are we like BlackBerry 7 years ago?
That is a kind of a pessimistic view to look at it, but looking at it in an optimistic view, the iPod is still one of the most popular devices out there because of that intangibility with the software as well, and the adaptability within that. That's the attraction of it. BlackBerry did not have that marketability. That's what the software is essentially how you're going to join those two products together to make it sustainable moving